Hello everyone, this is Vilas. In earlier videos, we talked about what day zero financial statements would look like. In this video, we will start the business and see how it will impact the financial statements. So let's get started. So it is the first day of the business. You are very excited to start your tea shop. You wake up early in the morning, open your tea shop at 8 a.m. You also call your friends and family for the inauguration. Just after the inauguration, you start your stove, you put the kettle on the stove, you put the ingredients and start boiling your first cup of the tea. When the cup of tea is ready, you sell it to your first customer for rupees 10. Once the sale is made, you make note of it in a notebook. As the day goes by, you sell more cup of tea during the morning, afternoon, and you also sell some more in the evening. You make all these notes in a notebook so that you can tally it in the evening later. And soon it's end of the day and you have to close the shop. Happily, you go home, have your dinner. You are happy about your first day. Then you open your notebook and look at all the notes you have made about the sales made in that day. You notice that you had sold 200 cups of tea in that day. Now you multiply that by 10 rupees, which is price per cup. You get 2000 rupees. This is the revenue which you earned on the day one. Once the revenue is calculated, you also want to calculate the profit. But for that, you need to deduct certain expenses. Then you remember your chat with Ramesh. Ramesh bhai had told you that the cost of material used per cup of tea would be around 4 rupees. So you use this as a benchmark and multiply that with the number of tea cups sold, which is 200. You get cost of goods sold around 800, and we call it as COGS, which is a financial term. Please remember this. Once you have cost of goods sold, you take the revenue, subtract the cost of goods sold from it, and you arrive at something called gross profit. So in our case, when we subtract 800 rupees from 2000 rupees, you get a gross profit of 1200 rupees. The gross profit, if expressed as a percentage of revenue, is called gross margin. In our case, we have a gross margin of 60%. Now that you got gross profit, you also want to deduct other expenses. So you start thinking about what all those other expenses are. The one expense is salary, which is the salary you are going to pay yourself. And let's assume that you are going to pay 15,000 rupees per month as a salary. This is a per month salary. You need to calculate per day salary. So if you divide 15,000 by 30, where we assume number of days in a month as 30, we get per day salary of 500. We deduct this salary of 500 from gross profit. Now the second expense is utilities. That is nothing but electricity bills, gas bills, etc. From your business knowledge, you know that the utilities bill will be around 3000 rupees per month. Similarly, you calculate the cost per day of utilities, which is 3000 divided by 30, and you get a number of 100. This is your utilities cost per day. You subtract this utilities cost from your gross profit as well. The another expense is rent. If you remember, you have agreed with your friend that you will pay him rent of 6000 rupees per month. So if you calculate rent per day, which is 6000 divided by 30, it comes around 200. We will also subtract this rent from our gross profit. After deducting salary, utilities and rent from gross profit, we arrive at a number called 400, and this is called as a EBITDA. This is very important financial metric. So what is EBITDA? EBITDA is nothing but earnings before interest, tax, depreciation and amortization. So basically, if you subtract all the expenses except interest, tax and depreciation and amortization from your revenue, you arrive a number called EBITDA, and it's one of the important financial metrics which gets tracked. Similar to gross margin, if we express EBITDA as a percentage of revenue, we get something called EBITDA margin. In our case, EBITDA margin is around 20%. Now that we know that we have to deduct some more expenses, let's start with depreciation and amortization. Depreciation is nothing but notional cost of tangible asset whose economic life is greater than a year. Let's say you purchase stove and utensils. You cannot right away deduct the whole cost of stove and utensils from this day one statement. What you'll have to do is take the cost of stove and utensils and spread it across the useful life of stove and utensils. Let's understand through an example. Let's say for a stove, the useful life is of 5 years. So what you will do is spread the whole cost of stove across 5 years, then calculate a per day cost. In our case, the per day cost comes around 11 rupees. Similarly, if you assume the useful life of utensils as 2 years and spread this cost across these 2 years, we get a per day cost of 14 rupees. In our case, the total depreciation will be the day one cost of stove and day one cost of utensil. So we get 11 plus 14, that is 25. So this is our depreciation per day. Now coming to amortization, remember that depreciation is with respect to tangible assets and amortization is with respect to intangible assets. So amortization is notional cost of intangible assets whose economic life is greater than a year. Example is like software and licenses. In the case of tea shop, there are no intangible assets. So Our amortization cost per day is 0. Now we subtract this D&A, which is depreciation and amortization, from EBITDA. Now let's talk about the interest expense. If you remember, you had taken a loan from bank of rupees 25,000 and you also have to pay interest amount on this loan annually. Let's assume that the interest rate is 10% and there are 360 days per year. So if we calculate the interest per day, it comes around 7 rupees. So let's subtract that from EBITDA. After subtracting depreciation and amortization and interest from EBITDA, we arrive at a PBT, which is profit before tax, and its value is 368 in our case. Let me explain PBT. It is nothing but profit before tax. This is a taxable income on which actual tax is calculated. Let's start calculating the tax. So assuming that tax rate is 25%, 25% of 360, which comes around 92. And once we subtract this 92 from PBT, we get finally PAT, which is profit after tax of rupees 276. This is our actual profit of day 1, which is 276. So the revenue was 2000 rupees and the PAT was 276 rupees. If I put this profit in a standard format, it will look like this table. Take a pause and have a look at it. Alright, so we have covered day 1 profit and loss statements. In next videos, we also will talk about day 1 cash flow and day 1 balance sheet statement. So I would request you to subscribe to this channel. Thank you.